But it is a rather complex transformation from a private entity into a publicly scrutinized and traded company as well. It almost sounds a little bit scary, and of course with very good reason. So now, an informed discussion focused on how to prepare, what to expect, and how to handle each bump in the road, because of course they are going to come throughout the IPO journey, including the success factors as well. We have a great panel standing by at a distance over there in the carpeted area, but running this panel we have the editor-at-large from Reuters, Axel Threlfall. Please welcome our moderator and our panel.
Good afternoon, everybody. As you just heard, this is about the process, this panel. You just heard about the context. We're going to talk about the process now. We're going to try and really look a little bit more deeply at the psychology. We're going to hear from someone who's done it himself with his company. We'll look at the pre-IPO, the journey itself, and the post, and get as much out of our panelists as possible doing that. In the interest of time, I'm going to introduce them very quickly. You've got their full bios in the program. Next to me is Jan Kemper, Senior Vice President Finance at Zalando, the online fashion retailer. His business was set up, I think, 8 years ago, is when you were set up in a Berlin flat share, IPO'd back in 2014, employs about 12,000 people now. James Markham, next to Jan, is the EY Global Tax Leader, strategic growth markets based in the US West Coast, with a focus on tax minimization strategies. Very big in the news right now, of course, James. Marisa Drew is co-head of investment banking and capital markets for the EMEA region at Credit Suisse. 28 years of experience in the industry, previously with Merrill's and Kidder, among others. And last but not least, Martin Steinbach, EMEA IPO leader for EY. In fact, you heard his bio when he introduced himself at the beginning, so I'm going to leave it at that. Right, let's get a conversation going now. Jan, let me start with you. How did you decide, together with your university friends who had set up this business, that now is the time to do this, to embark on this IPO process?
Well, literally it was a process that started somewhat I'd say 24 to 36 months before the actual IPO, and it was not that we said, okay, now it's the right time to actually go for the IPO, but rather it's about looking out for 2 or 3 years and thinking about, okay, what if we want to have that opportunity in like 3 years, what we have to do today and over the course of the next 3 years, which comes naturally, in order not to be rushed into that process about 6 or 9 months beforehand.
You know, of course it's about liquidity and raising money, et cetera, but how much of it was about you personally and the psychology, your psychology and the psychology with you and your colleagues, deciding this is something we're actually going to do now?
I would say at the beginning of 2014, that was then the timing when we said, okay, now let's go for the final phase, which is normally then 6 to 9 months, where the entire company is focused and you have to run through. And then it was a combination of several reasons, because we said, hey, private funding back then was not possible at that larger amounts anymore. So we say, hey, tapping into the capital markets by now makes sense.
Yeah.
And then let's see how that plays out. Is the windows open somewhat in the earlier part of the year, or we rather go for autumn, fall, and that's when we kicked out. So it was rather than the decision of the management saying, hey, now let's go for the final 6 months.
Okay, Marisa, let me ask you this. There seems to be this trend right now, and I think we heard about it in the last panel, of early stage companies staying private for a little bit longer. Now, of course, we would put that down to, well, some would put it down to the market environment. Others might say awareness, especially among some of the smaller companies and the entrepreneurs, of the whole process and how long this thing takes and the whole rigor of it all. And then the entrepreneurs who just don't want to let go of the reins. Why do you think more companies are staying private longer?
Well, I think what's getting most of the headlines are the tech companies in the States, the so-called unicorns, who have had a lot of press recently about staying private for longer. And I think the rationale for those types of companies is that there's almost unlimited sources of funding on a private basis for them, and at ever increasing valuations. And so if that is the case, then that allows that decision to be deferred in some respects if the ultimate goal is to go public until you're a bigger company with a higher valuation. So I think that that's the motivation at that end of the spectrum. At the smaller end of the spectrum, I think you hit the nail on the head, is that it is a daunting process. It's a huge amount of investment of management's time. There's a cost associated with it. And then post-IPO, as a public company, then you have a duty of care to your shareholders, and that has another dynamic which we can come on to, I guess, in more detail. But answering to the public investor community and all that entails is a lot of work, effort, time, and so forth. And I think that there's sometimes a reluctance to necessarily put yourself out there at an early stage of your company before you are your business model is fully proven, or you are on a glide path to being able to demonstrate that repeatable growth that the last panel talked about.
Martin, let me put this to you. If you're brought in to do one of your famous readiness assessments, what do you most hear from youngish companies concerning a possible hesitation to going to market? What's at the top of their list?
I think it starts typically 12 to 24 months pre-IPO with a strategic discussion about, is the IPO the right choice? Should we stay private, or should we move and transform into a public listed companies? And there are many reasons, and they depend on the different perspectives. We have private equity as shareholders, we have family business as shareholders, and they have also all different criteria, what's the best route. But I think the great benefit of a listing is you can diversify wealth, you have a huge liquidity of capital market, you can approach the capital market for a second time, you can bond people via stock option plans and so on and so forth. But on the negative side, we heard, okay, there's transparency associated. We heard about IFRS, and IFRS makes a company globally comparable. And the big question is, okay, bottom line, is the IPO the right route? And there is no single answer.
What sort of questions should these companies be asking you guys at this stage of the process, do you think?
Well, let me leverage off from that. So we had a situation a year and a half ago where a company that was family-owned, I think late, I don't know, they got into a stage where they did get some private equity. And in fact, Credit Suisse was the banker that was going to take them public. So I remember this because we're in San Francisco. It's this huge room. And if you've never been to a kickoff meeting, it's like you got the accountants, you got the attorneys, and you've got 5,000 investment bankers who have three names.
We come in force.
Who have three names, and the first is always an initial or something like that. All went to Yale or Harvard or something like that. But so anyhow, there was this talk about how big the company is going to be. This was going to be $1 billion value. Everybody's like doing the happy dance. And to take a step back, they were audited by a regional accounting firm, and they did a bake-off, and they chose the best firm, of course. And so we get in, we start the audit, and find out that things aren't exactly. And so what was supposed to be a 3-month close turned into a 6-month close. And at the end of the day, they ended up selling themselves because they couldn't get to a readiness standpoint to where they could have that public document ready.
Right.
So the readiness factor is are you ready to act like a publicly traded company? And if you're not, then it causes delays. And in this situation, I think they took like a 40% haircut in terms of valuation.
Jan, I want to look at that, and I want to hear from you honestly about advisors, about investment banks. Did you work with EY to start with? Let me ask you that. Get that on the table or off the table or whatever.
They were until 2010, they are auditors. Yeah.
Okay, they were. Was there a sense at the beginning of this process when you were desperately trying to get your company ready of advisors, ECM bankers breathing down your neck, saying, you guys have got to get on with this?
Yeah. Good thing is there was one thing we desperately wanted to avoid, because we had a lot of people in our finance department that worked as investment bankers beforehand. So I was working with some of those big names. Two of the people actually involved in the IPO process were also bankers beforehand. So we said, hey, let's do that kind of readiness assessment early before, but not with a clear perspective, okay, to do the IPO, but rather to think what is still missing if we compare ourselves to the top leading private or even public companies. And so what is the roadmap for the finance department to do anyhow, in order to then decide 6 months beforehand, okay, do we want to really go for the fast track and go so on?
But did you ever feel pressured by the investment banks or the advisors?
Well, in a way, I mean, the investment banks, once you're out of the at least the sense that you might do an IPO in the next 12 to 18 months.
It's like the media, right?
They're hunting you. And
I got to hear from you in a second.
I was going to say, defense of investment banks.
Sorry, Jan.
I mean, and especially that's a huge stretch for the finance department, because if you not manage that properly, you can spend, I don't know, 4 out of 5 days of your work week actually with bankers, and that's not the key. I mean, if my piece of advice for anyone actually considering that kind of process is not speed dating, is nonsense. So meeting 15 investment banks like in 2 weeks and then to decide, okay, what is the right team actually to bring you through an IPO is nonsense. Rather engage earlier, and then not with the entire bank, because hey, having a bank pitching lead tables, industry pages, whatsoever, doesn't bring any further. It's rather about finding the right industry banker you are trusting. And that is helping you also in the process before, like 24, 36 months, engaging intellectually strategic discussions you can have. Because the execution power of the big investment banks, there are hardly any difference in it.
I'll give you the right to reply, Marisa.
Okay.
I mean, you know, it's a difficult question to answer, but over your career, working with companies about to IPO, trying to convince companies that now is the time to do it, get moving, grasp this opportunity. I mean, how much of that still happens from the investment bank? Sure. Maybe a little bit too much of that still happens at the investment bank.
Well, first of all, that wasn't a tee up for Jan, so thank you for the comment, because it's very much true that, you know, I think I'd certainly like to pride myself in my career of always putting myself in the shoes of the client. So if you think of yourself as part of the family or a partner, then what you ought to be doing is stepping back and giving good advice. And half of the time, we will tell a company, actually, the public route is not the right answer for you, either at this stage of the life cycle of your business or in terms of where the markets are for your type of company now, or where you could maximize value. So the most important thing we have to do is start with, what are your objectives? Financial objectives, strategic objectives, your objectives for your employee base and so forth. And then you determine the right path, as opposed to starting the other way around, which is, this is a super hot sector, let's all get you out there as fast as we can. Now, I won't pretend to say that you know, doesn't go on, because when markets are good, one of the frustrations you have as a banker, and you are telling a client, markets are really good, go now, there's always a little bit of feeling that there's some skepticism that we're, as we say in our industry, talking our own book. So markets are volatile, and therefore, if this is an objective of the company, first of all, 100% be ready, because the one thing you cannot control is the market condition.
Sure. I guess on the back of that, and I'd be interested to hear from the EY guys as well. Yes, the markets can turn on a dime, we know that. The longer that process period goes on, the more likely you're going to come up against something that might make you rethink. How do you streamline this whole process? You know, make it a little bit shorter, which I imagine would help everybody. Come on.
I think you need to have the right team. The internal team means you have to enough resources, and also the right advisors, as mentioned by Jan. And you need to have an efficient IPO project management if you really want to get ready in, let's say, in 6 to 12 months, which is really tight. And it also depends on the right IPO destination, and it depends which stock exchange you're choosing. It takes sometimes a bit longer, especially if you go abroad, compared to stay at home with a national listing.
Can I just come back to something that you asked earlier, which is, what should companies be asking themselves? So there's what I would call the process-oriented things about timeline, and do you have the right resources internally? Do you have an IR function? Or you've got the right corporate governance set up and all that? But I would say at a fundamental level, one of the questions I would advise companies to ask themselves is, who do I look most like? So one of the things the investor community does, and you probably heard a little bit of this today, is they benchmark companies from a valuation point of view and a business plan point of view against each other. So if you are in a space where there are plenty of comparables, then the analytics around valuing a company and determining at a given moment in time what that company is worth becomes somewhat easy, and you then, on a variety of financial metrics, can say, I've got a growth profile that looks like this and a margin that looks like that. If you are a disruptor, and you are somebody new, and you really do have a different business model, then you've got to ask yourself, what is it about my story that would be attractive to the investor community? That requires quite a bit of engagement to determine what is it that's going to get them excited about what you're offering. And then you need to be able to shape those metrics and define your own way of being looked at.
Yeah.
So, and that's a really important thing, because if you're that pioneer out there and no one's ever seen it before, what you want to do is set a series of KPIs that you're going to live up to, that's what you're going to communicate to the investment community quarter after quarter after quarter, on which you're going to be judged. And I think that's a big piece that sometimes I think gets a little lost in this disruptor arena.
But
go ahead.
Marisa, that's interesting, because don't you see some parallels between .com and disruptors today? Because .com, you did not have KPIs.
Nope.
And a lot of the disruptors you don't.
Yep.
So then how do you evaluate that, or how do you advise people?
But I think the key with sort of when the .com bubble blew, one of the biggest issues was we had a lot of companies with what we call the business plan and a prayer, and they put their businesses out there and said, these are my growth profiles. And back then it was eyeballs, it was all about eyeballs. And I'm going to get this many eyeballs, and it's going to translate into this, and all these business plans were great hockey sticks and what have you. But then what happened was each successive piece of information that got put out into the marketplace after they went public, they missed the numbers, they missed the benchmarks, they missed everything. So the great problem there was the business models actually didn't really work. I think a little bit of this is, when I say defining your KPIs, what is it that you can live up to and you really, really know you can deliver on? Because the IPO, as we heard on the previous panel, is only step one in the life cycle of the company.
Right.
Then you've got to live as a public company quarter after quarter.
Here's another question that sort of comes out of something you were just saying now, and I put this to you, Jan. How do you, and I'd be interested to hear from everyone, how do you test the appetite of the market without giving too much away at the beginning? Before you bring the investors on board. How do you do that without giving too much away? How did you do it? Was it something you worried about?
Well, as Marisa put it, the IPO is a first step, but ideally, obviously, it's not the first step actually you did in the entire process. So before you, as a private company, as you did one or two maybe private rounds beforehand, you are in contact with the investors anyhow. You are potentially in contact with one or two of the investment banks out there. So there is a lot of opportunities actually to challenge your story, to challenge your operating model in a way, so you know what kind of appetite might be out there. In the process, yes, there's a kind of pilot fishing and so forth you can do, but it's rather not something ideally you do in an IPO process. That kind of getting the feeling of the market, but it's rather something you build up over the course of the 2 to 3 years, actually leading to a potential IPO.
Is there a system that you put in place, would you say, Martin? What do you advise companies with reference to what Jan was just talking about?
I think you need to have only one choice to make a good impression. It's hard to change this first impression. So it's all about preparation. So to find the right KPIs, to find the right equity story, and to prepare a kind of investor presentation and a fact book. And banks can help you to find the right investor to test this story. And there are many names behind: pre-marketing, pilot fishing, and so on and so forth. And the logic behind is not showing up as a newcomer, rather than being already known and hey Jan, you're back and now you're going public. We know you already. So position yourself early with the right set of KPIs and really listen to investors, and to integrate the feedback and comments continuously in your equity story. Yep. The equity story is not final. It really changes every time, especially if you're a disruptor.
And so this is what we advise well before an IPO and you're actually trying to raise your capital. You go out and meet with a select few, and this is where your advisors, banks, and advisors like EY can help you to say, here is a group of natural buyers for your future equity story. Let's go and road test with them on a completely, there's no obligation, there's no nothing. You go out and you begin to tell your story. And these investors are all looking to put money to work, so they're very eager to have those kinds of communications. And by the way, if that all goes well, then they can be the anchor tenants in your flotation, which creates a huge amount of momentum before you sort of officially kick off the book building process. But what we absolutely find is if you go out there and you find those investors that are willing to engage with you, they will give you feedback. They'll help you evolve how you tell your story. They can help, they're seasoned investors. They can, they can act as sounding boards to a degree. But equally, and not just at the upfront part of the process, post-IPO. So what typically happens is no company is ever going to hit all their numbers all the time, indefinitely. Nothing is a straight line. We hope directionally it's like this, but there's always going to be bumps along the road. And those companies who have had early engagement with their investors and think of them as real partners, they understand the fact that there are exogenous factors that come into play. And those companies tend to perform better than the ones who actually have no early engagement and just put it out there on the day, because then you have people who are probably less engaged in the story and less bought in.
Yeah.
So I think that's a big piece of it as well.
Maybe two tiny points for that. I mean, first of all, I guess crucial points, it has to be your equity story, and it has to be your business plan. And with you, I mean business plan of the company or the management. Because Martin referenced to that, equity stories might change, but it should be only like nuances that change in a way. The worst thing that can happen is you meet an investor at one point in time and you tell that kind of story. 12 months later, you're sitting at the same table and saying, yeah, it was nice, but we changed direction entirely. And you do that again 12 months later. It's not that kind of trust building they actually need. Same with the business plan, because you talk to different people out there. Yes, you might not lay out all the numbers, but there are specific KPIs and so forth. And investors, they do not forget. Yeah, and you might only have 2 or 3 touch points over the course of 3 to 4 years, and they will ask you, okay, what happened to that kind of KPI? And when you continue to tell them, yeah, we ditched it, or that is a number, we're not looking at it anymore, that's not cool.
Yeah.
So when you ask, another thing is the analysts that are following you.
Yeah.
So again, if you don't have core analysts that are following you, then that becomes a big issue.
I mean, we'll come on to that when we look at the post, when it's all done. We'll come on to that, because that's an important piece. And I think psychologically that's an important piece as well. But let me move it on. So this journey has started. You're on your way. You're trying to run a business at the same time as doing all of this other stuff. To what extent does the momentum that you've created stall? To what extent does entrepreneurship get stripped away because this process has started? And you can be as honest as you want.
I'd say if you consider two key things beforehand, it's like start as early as possible with the fundamental stuff you'd have to do anyhow, and do not try to squeeze it into the last 6 to 9 months, like building up a solid accounting function.
So good time management, basically.
Exactly, legal functions, so something you have to do beforehand anyhow, and so convince your management colleagues that investing actually into a solid finance foundation, legal foundation, GSE governance in a way, is necessary, and you have to do it anyhow in order to run a big company, a unicorn, somewhat along the way. That is crucial, because it takes a lot of that pressure away you normally see in the last 6 to 9 months. And second, you need a very strong second management level. So actually the key 10 to 15 people that are able to run that kind of process. If you have that, and that is what experienced we at Zalando, is you can keep a lot of the pressure of that kind of process away from the people actually running the operating business. By,
of course, hiring a lot of new people in, right? And so I imagine human capital considerations, financial considerations. I'll be interested to hear from you guys at EY. What do you advise a company the size of Zalando when it decided to embark on this process in terms of bringing new people in to run this stuff whilst they get on with running the company?
Yes, but crucial point is bringing those people in not when you plan the IPO, because it'll take you a lot of time actually to bring them up to speed.
Yeah.
And that'll again, takes away capacity from the operating people.
Quite a way before.
So it's rather you decide, hey, you will be a medium-sized to large-sized company in 2 to 3 years.
And did you? Sorry to interrupt, but did you get that yourselves as a company, or did you have to hear this advice from the advisors?
No, we had that idea, and that is why with Ernst & Young we did that kind of IPO readiness 2 or 3 years before, when we did not even think about doing an IPO actually, but rather getting a sense, and then taking actually that kind of result in order to also convince other people in the management and also with the stakeholders to say, hey, that's something we have to do anyhow, let's go for it now, because it also gives you more security with regards to a potential IPO in the future.
Fun.
Yeah, thanks, Jan, to mention this IPO readiness assessment. But I think if you compare a private company and a public company, there is something new in a public company, which is the investor relations department. These are the guys who manage regulatory disclosure to regulators. They manage the guidance in the market towards investors, shareholders, analysts. And you need to set up a complete new organization. And typically, those guys are also perfectly for the IPO project management. So if you hire somebody from the IPO project manager, this person is ideally the one who's doing the IR, the investor relations work afterwards. This could be also a way to speed up the process, getting IPO ready.
But I mean, IR, financial PR, yes, things you have to think about. Well, how early actually? I mean, you say yes, you need to put all this stuff in place early, but when do you actually start using these people on a daily basis? At what stage in the process?
Yeah, so it starts with the IPO project management. If the shareholders decide, okay, let's kickstart the process, and you need to define, typically this is with the CFO, but the CFO has enough to do. There's lots of running business, so you need to follow your business opportunities, and the project consumes time. So you need to have 1 to 2 full-time employees to manage this tight process. I'm talking about 8 to 12 months before IPO. To manage all advisors, they want to have for due diligence this and that, and need to organize this data for those advisors. And then with an effective project management, you can set milestones. Jan mentioned the IPO roadmap.
Yep.
So you are not ready at the beginning, that's clear. But if you are ready at the beginning, you did something wrong as a private company because you have too much processes, too much people on board. So you need to transform the company from private to public in 12 months. And I think that takes two people. And ideally, they are following with the IR work afterwards.
In this process, what did you worry most about right up until the point when you went public? What was your biggest concern, do you think?
For us, in that specific situation, was rather the IPO window. So is it possible to go out or not? But that might have been a specific or special situation for Zalando because we felt well prepared even before we kicked off the last 6 months. And so my biggest fear when we look a bit back, like 18 months, 24 months, was rather being rushed into the process by shareholders, by investment banks, advisors, whatsoever, without being ready. And then, I mean, you can easily do an IPO process in 3 to 6 months if you do not want to sleep, if you have enough advisors you put on there, if you take all the resources from your operating business doing it. But the problem is, day one after the IPO, you're alone. It's your company and you're responsible for it. So it's your risk.
You know,
and that, in the end, you always have to bear in mind when preparing that. So taking that out.
You know, it seems to be, listening to Jan, you know, they were a team that in their minds had it all ready, had everything in place, had really prepared well. How often do you see such a well-prepared young company preparing for an IPO? I mean, do you often work with companies and think the mentality is not right?
Which is, you know, when we would probably advise then don't go public, or, you know, you need to take the time and invest the time. There are also other ways to get yourself ready for an IPO that it's not as binary as this is the only way to go. So other alternatives would be to have a first foray into the capital markets through a public debt offering. I call that oftentimes the baby IPO because the type of investor communication is a bit different in the public debt markets versus the public equity markets. So it creates the financial discipline, the reporting requirements and discipline, and it's the beginning of an IR process, but it's a slightly different exercise. So that's one way of going about it. Another way is, you know, if you're looking for capital to be invested in the business and you want a smart partner, private equity is another route. And oftentimes, if a private company does take a partner in the form of private equity, you know, they're very seasoned professionals that have, you know, seen it all, done it all 100 times over, and they can be very good sounding boards as well. So there's lots of ways to go about this, depending on what the objectives of the company are and the readiness factor.
Okay, so the company IPOs, what are some of the biggest mistakes companies make then, at that stage? Either one from EY.
Let's talk about some thoughts that I mean, you have, I don't know if too many people in the audience are familiar with Etsy. Raise your hand if they are. It's basically Amazon for home goods. So they did a tax strategy, and this is all in the newspaper, so I'm not, and they're not a client, so I'm not talking out of school. But so basically they adopted a tax strategy, and if you've been reading the papers, having your taxes in a low tax jurisdiction is now like a bad thing, and unless you can explain why you're there and you've got a great story. Well, they actually set something up in Ireland. They go public. First quarter, they miss earnings, And one of the reasons is they said that it had not been set up soon enough, and so there was a tax hit that they didn't expect. Now, that's one of the things, the corporate structure, you got to get that right sooner. I think another thing is employee situation. So a lot of companies give stock options. And I think it's interesting because some of these companies, if they, you typically locked up till a certain number of days until after the IPO, but as soon as that happens, then you know, you see Porsches and Audis in the parking lot and everybody's doing the happy dance. But it becomes a big employee retention issue.
Yeah. But it amazes me that companies still get that stuff wrong if they've got all these advisors surrounding them throughout this whole process. Surely it's your job, and you didn't work with Etsy, but it's the advisor's job to say, be careful, don't do this. Wait, if you want to get it right, you play it like this. No?
It could be a window issue too, though, right? I mean, and you tell me, I mean, not that investment bankers ever push somebody into a window, but if you're close enough to being there, then you take advantage of it.
Yeah.
I mean, you know, the numbers go stale after a period of time. It's the concept that if you do miss a window from a financial reporting point of view, then you are locked out of the market for a period of time. And sometimes exogenous pressures like that prevail and that push companies to go before they're ready. But this is why we say if you start early, your chances of managing those vagaries are infinitely better. And no matter what timetable you set out at the beginning, trust me, there's always going to be something that intervenes and disrupts that timetable in some form or fashion. So early is best. But if you ask me what is the single biggest problem for companies that have just recently gone public, it's missing your numbers. It's that first quarter out. So this concept of under promise, over deliver. I could not emphasize that enough. So when in doubt, I'm not saying sandbag the numbers, but just make sure that you're not going to miss, because everyone at that point is watching you. And it is so hard to claw your way back if you have a miss versus if you then get the benefit of the doubt if you over deliver. So that's the number one thing for me.
And I'm glad you raised this because, of course, let's move it on to post. Relationship with analysts. Clearly equity analysts and what they do and the sort of people they are and the sort of things they are looking for from newly listed companies is critical. How do you play the equity analyst?
Well, play sounds
maybe
like an
that's the wrong word,
it.
but how do you build your relationship in the right way?
Absolutely, it's in some respects it should be common sense that the more you develop a relationship. Again, it's back to this, the more you're able to articulate your story very well and very clearly and very precisely, the easier it is for an analyst. Because if you just put yourself in the analyst's shoes, they're outside looking in. And, they are listening and digesting what you say, and then they have to form their own opinions. But the more that you can help lay it out for them, the easier it is, and the more you communicate. So the other sort of rule of thumb, if you will, is if you do miss your numbers, and that day will come, most likely in everyone's life cycle, is that you don't then go into a hole and not communicate. You engage. And the more you're out there post-IPO, going to conferences, talking about the business, helping to articulate, because businesses go through cycles, competitive dynamics change, all those kinds of things, but helping people understand will, again, carry people with you. I always say that you can trade bad news and you can trade good news. It's very difficult to trade uncertainty. So usually then people just, in the absence of that, might just run for the hills if they don't know what's going on. Your natural bias is sell, and then that's going to put downward pressure on the stock.
And that, of course, talks to having a good financial PR in place, a good IR
things we were talking about earlier.
The things we were talking about earlier. Sorry, Martin, were you going to?
So I think it's all about managing expectations, because investors don't pay for history, they pay for the future. And it's also building and establishing confidence.
Yeah.
So you see it in the profit warnings. So if you have a profit warning which is disclosed by an ad hoc disclosure, you see an 8% minus. If you send over a profit expectation, so you end up with a higher profit, you get only a 6% uptick. So not fulfilling on your promises, you will be punished, and you see it directly in milliseconds on your share price.
Go ahead, Jan.
And I'd say it's especially, meeting the numbers is especially important for younger management teams, especially for new tech companies now coming up, and you have people like myself, somewhat in the mid of the 30s, early 30s, mid of 30s, and talking to investors out there, and then you have to build more confidence than potentially a person sitting there with like 45, 50 years, 20 years of experience in that area. So meeting the numbers even more important. And second, when you meet the numbers, it's easier then to stick to the set of KPIs you normally feel comfortable somewhat giving out and guiding the market towards. If you have one or two misses, then naturally you have to go one or two levels deeper in order to restore confidence.
I mean, it's interesting. Something I find particularly interesting, the numbers should speak for themselves, and the analysts will write a lot of their stuff based on what the numbers are telling them. But how important is that relationship that you personally have with an analyst when you travel around and you do your road shows and you tell them your story and where your story's going? How important is that part?
I'd say it's crucial. It's crucial on the analyst side, but also on the investor side, especially talking for Zalando now, because we are a European company. A lot of our investor base is coming from the US or via the UK, but also from the US, so funds sitting in the US. We're not present there, so it's a lot about actually explaining the Zalando story, bringing them over, and that, yes, you can do it via conference call, or you can also do it with press releases and so forth, but there's nothing that can beat actually one-to-one meetings on that.
Have you ever, since you IPO'd, have you ever sat in your boardroom with your colleagues thinking, this analyst or this analyst just don't get us? They're getting this story wrong. They don't understand us.
Yes, I mean, not particularly one that is not getting the entire story, but there are obviously notches where you say, man, we explained that 3 times, 4 times, 5 times. We should get to that point, but it's simply consistency. You have to continue, and we see that. We started with like 7 analysts covering us after the IPO. Now we have 17 actually do so, and the stories and actually the grip on the Zalando stories along the way continuously improved. And that is not something you can change from a week to week. It's rather a month, a yearly game, I'd say.
Very quickly, anyone got a question? If you've got a question, put your hand up. If you don't, we've got a few minutes, and we could go on for another hour at least. But just wanted to give you that opportunity. No? Good. I have a question that we'll use as a sort of close. It's a bigger question, and it talks to younger companies and entrepreneurs, and that is this idea of having a purpose when you set up a company. And the reason I bring this up is because I've spoken to a lot of companies recently who set themselves up with this purpose in mind. They then go to the market. They're at the beck and call of a short-termist market, the institutional investor who doesn't get purpose. Do you battle with that?
Yes, and I extend it to purpose and culture.
Yeah.
In a way. Because they are the 2 ingredients, in a way, the 2 competitive advantages you cannot copy. And if you set that up in the beginning and you consistently follow through, being it in a private setting, in a public setting along the way, and especially same holds true for culture building, that is an extreme value booster also in the future. Not and we discussed that in the preparation of that panel discussion. Especially in those markets at the moment where you see a lot of more traders than investors, how I call that.
Yeah.
Yes, once in a while it's get difficult somehow to transport that story, but in my eyes it's crucial.
How to Martin and James, and then Marisa will finish up with you. How often, and I'm just throwing this out there, do you find yourself saying to companies, you need to think much more short term if you're going to make it work? If you're going to make it work in the market, you're IPOing, your stock's trading, analysts are writing about you, institutional investors are looking to buy your stock. They want to see results now.
I think that the right timing is one of the 5 success factors I see. So it depends on the life cycle, the IPO sentiment, on how you are positioned. Are you a consolidator, a disruptor? So it really depends on the timing. So case by case.
I think it gets back to readiness, because if you've done the planning, then you're ready for the short term. In other words, you know, once you go public, you've got quarterly reporting. If you've been doing that for 2 years prior to going public, there won't be surprises because you're ready and you can deal with the short term. You can give the long-term story, but you're ready with the short term.
Mm-hmm.
I guess I would say something slightly different. I would say have the courage of your conviction. So if you believe in the long-term vision of your company and you stand for a core set of values, people may not get it at the beginning. So yes, you've got to be mindful of the fact that you're going to have your first quarterly report and your second quarterly report, and we've kind of covered that, I think. But in the longer term, I don't think it's our job, any advisor, to tell a company that they ought to run their company for the next quarterly report, as in manage the entire company around that. And a very good example, and there's a really interesting piece that's just been written about Jeff Bezos, who has consistently said, I've got the long-term vision in mind, and every time he takes that cash flow and goes and invests in another thing that is going to either slow growth or consume capital or affect profits as he's investing, his stock takes a hit.
Yeah.
But guess where that value's gone over the
Well,
last
I mean,
decade.
and
So,
you reached that
know,
point that Tim Cooks have reached, where you have you're brave enough to say to the institutional investor, if you don't like
And
it,
you
don't invest
created-
in our
Yep.
company, right?
Yep.
Final word from you, Jan. Do you ever find yourself thinking, I wish we'd never taken this company public?
Nah, not yet.
Not yet?
Not yet.
Yeah, not yet.
So it's coming, maybe.
Well, it has been a very short time since we IPO'd, and looking at the markets at the moment, we still clap our shoulders and said, hey, it was the right timing 2 years ago, and not in the bumpy road since then. But ask me the question in 5 to 10 years. So if we then fulfilled our vision somewhat to become the disruptor in the fashion e-commerce part in Europe, and I think we did everything right. If that additional burden of quarterly reportings, additional information requirements and so forth somewhat slowed us down, if we didn't reach it and somewhat pulled us over, then I might answer that differently. But until now, I'd say no, it was the right step.
All right. Look, the clock is saying naught, so we've reached our time. All I'll say in conclusion is this: it's always, without a doubt, the best way to hear it from the horse's mouth, and we heard it all from the horse's mouth here today. Thank you very much to all of our panelists.
Thank you.